My name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the hour is Julius Kempenaer. Julius, introduce yourself to the audience. Who are you? What's your background? How'd you get involved in markets? And how the hell did you come up with this whole RRG thing?
All right, that's a lot of questions. That's probably enough for an hour. Okay, so my name is Julius de Kempenaer. So, Michael, you had that pretty correct for an English-speaking person. It's usually quite difficult. So, congrats on that. I'm based in Amsterdam in the Netherlands. And so, how did I end up in finance? My background is in the military. After high school, I went to the Royal Military Academy in the Netherlands. I became an Air Force officer with a logistics economic background. That was my study. So you always had to do two things. You had a wartime job. For me, that was local air defense control. And my daytime job was economics, basically running the finances and the logistics of an airbase. Maybe that's an interesting introduction how I ended up in finance, because everybody has a different route. And mine came when I had to do my thesis, as I said. And at that time, the Dutch Air Force was buying General Dynamics F-16 jets. And as you can imagine, these things were there were millions and millions of dollars each. And there is a law in the Netherlands that dictates that anytime that a governmental body engages in a deal that involves a foreign currency, we have to buy that currency immediately. So this is we're talking late 80s, mid 80s, and those of you who've been around may remember that at that time the US dollar was sinking in value quite rapidly against, at that time, was the Dutch guilder. So Dutch Air Force ended up with hundreds of millions of US dollars on their account, which became less like every week. And I had just read a little bit about options, and the European Options Exchange had just started trading. So I thought that's an interesting subject. So I wrote my thesis around how the Dutch Air Force could limit their risk on that big currency position by using options. So that got me interested in finance, got me in touch with a company that was teaching options courses to retail investors. And they were using a lot of technical analysis. And that's how my whole journey into technical analysis started. And then after my stint in the military, I resigned in 1990. I was a professional military, so I could have stayed until my pension. But if you remember 1990, that was the end of the Cold War. The wall came down. Everybody thought that the world would be very, very peaceful going forward. And, budgets for defense forces were cut. And I just, there was nothing to do for me anymore. So I left the Air Force and I started to work as a portfolio manager for a big life insurance company, Equity and Law, and found my way, specializing more and more into quant technical analysis stuff, basically ending up where I am right now. So that's the entry. What was the other part of the question?
No. Hold on. That's a lot there. Okay, so hold on. So talk through to the audience. So back in the 90s, I would argue that technical analysis was still pretty taboo, may not be the right word, but was not really sort of taken seriously, right? I mean, it was much more about fundamentals, I think, as a portfolio manager back then. Talk about just the evolution of how technical analysis, quant strategy development has changed over time, and how'd you kind of navigate that? So in the 90s, you're starting to believe that there's these ways of looking at markets beyond balance sheets. But you don't want to necessarily outwardly say that.
No. It's totally true. I mean, it was all fundamentals. There were technical analysts out there, but they're a rare breed and maybe not taken seriously. I'm not sure whether that's the totally correct description, but in many cases it certainly was. And when I ended up as a portfolio manager, I was a junior portfolio manager at Equity and Law, and it was all about fundamentals. And I was sort of the odd one out. I still don't know how they took me for the job. I think it must be something else than the technical analyst stuff, because if I think back now, I don't think I really pitched that in my job interview. It was more my interest in markets, interested in investments, and my then very new experience into options and options trading and the theory around it. And I think that the people that I started to work with there in the investment department were quite open-minded, so they weren't necessarily killing my initiatives. And I remember what I did there was quite quant orientated, but from a fundamental angle. I was collecting. I remember this was early '90s, so the internet was like not really there yet. The Bloomberg terminal that we had one Bloomberg terminal to share, and it was one of those with these, itchy keyboards that with all the so you couldn't really type on it. You just had like equity and blah 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 and stuff. And we were getting all these massive written reports from brokers, and I started basically keeping a spreadsheet with all the recommendations of all these brokers for the various companies, and basically trying to quantify what people were thinking, what the market was doing, how far we were from their price targets, all that kind of. If you go on a Bloomberg terminal or an Icon terminal right now, you can just you have all that information on your fingertips. But I was recording that in spreadsheets and trying to work my way around it. Meanwhile, looking at the odd graph left and right. So yeah, it was a little bit under the table, I guess. And it's it helped me, and I started doing some courses. They allowed me to do a course, and that was interesting. And it sort of came naturally, I guess. I don't know. It's it evolved over time. And after my stint at Equity and Law, there came a job opening for a technical analyst. It was actually the job description was technical analyst at Robeco. Maybe you've heard of it. It's a pretty big asset manager in the Netherlands and now actually in Europe, and it's owned by a Japanese company right now. And I started working as a buy side technical analyst, which was quite modern at the time. Although probably Fidelity in Boston already had technical analysts at that time. So on the buy side, there seemed to be a little bit more uptake on that. And that's where I really started to use technical analysis to the fullest. I was given a lot more freedom to educate myself, to do courses, to go visit conferences and symposia. I met with a lot more like-minded people, and that's where I really started to pick up knowledge. At that time, I started doing my CMT levels 1 and 2. What can I say? Yeah, I mean, I think late '90s, early 2000s, quant investing became a thing, which is quite interesting because I always thought that quant investing was very much like technical analysis, but it came from the sort of the academic world. And in the academic world, technical analysis was a dirty word. It was sort of taboo. But when you said quant investing, everybody was all over the place. Well, to be honest, I don't think they're much different. We both look at time series. And I always joked that a quant investor is a technical analysis that cannot think without a Pentium computer below his desk. A real technical analyst needs a graph, needs a visual inspection. A quant investor needs a computer to do that work for him. But I mean, they are, in the end of the day, they're very much alike. We study time series, we study relationships, we study intermarket relationships, correlations, all that kind of stuff. So I think we're very, very much alike. And yeah, as you know, it's now way more accepted than it used to be.
Yeah, no, it certainly evolved. Although I think there's a downside to that acceptance, which is that there's a lot of things, as I'm sure you've seen in the field of technical analysis, that, putting it nicely, are complete and utter bullshit, right? In terms of just when you test it. Right, and kind of goes a little bit to your point about sort of the visual versus the sort of more quant kind of mathematically driven type approach. A lot of things in technical analysis, when you back test it, tends to not work. And we'll get into relative strength, which is one of the few things that does have sort of a persistence over time. Yeah. But talk about how you over time started to figure out what works and what doesn't. Listen, I was one of those kids when I was growing up who read Edwards and McGee, right? And with hindsight, it's like a lot of the stuff around technical analysis with Edwards and McGee is just not true.
Maybe not to the degree that they describe it in the book. Although I still have a very early copy of Edwards and McGee on my desk, because I believe that when you look at like the pattern recognition and trend analysis type stuff, what they've written there for me holds a lot of value, because they sort of describe the basic ingredients and elements on trend analysis and price formations, so chart patterns. And I agree with you. There's a lot of people give technical analysis a bad name, and sometimes I read stuff and then I feel like I should respond, but then I probably against better judgment I don't.
That's my curse, by the way. I don't have any judgment. I respond to everything that I see that I think is just silly.
Yeah, I mean, if you have to, I mean, if you're on Twitter or Facebook or wherever, and you have to comment on everybody who publishes a chart and draws a trend line that connects only 2 points, then it's a day job, and it makes no sense. I mean, you can connect any 2 points on a chart, but that doesn't make a trend line. That's one of the very few things that I think, how in the world can someone think that connecting 2 points has any meaningful value? So yeah, there is a lot of bullshit around, and that's too bad, because it provides ammunition to the people who don't like or think that technical analysis is voodoo and doesn't work. So we still have a battle to fight. Although I've always learned to pick your battles, because you can't win them all, and it's about winning the war and not all the individual battles. If someone doesn't believe it, someone doesn't see any value, then all right, tough luck. We'll find someone else.
Okay, so let's get into what works: rotation, sector rotation, analyzing where money is flowing.
Yeah.
First of all, lay out sort of your framework around relative rotation, and how'd you even go about coming up with the visuals? I mean, I didn't realize that you were connected to it, but I've seen the relative rotation graphs on Bloomberg terminals forever.
Yeah, that was. I mean, so how? I mean, we got to go back to, let me see, early 2000s. I was working as a sell-side analyst for an investment bank in Amsterdam, and you got to know that I'm the shittiest salesperson on the world. I hate it. I can't do it. I love markets. I love to study markets. I love to give an opinion on markets. But selling it to someone else who doesn't want to be sold is just not my thing. I'm really not. I don't have the patience for it. I don't have the persistence to do it. But I had to do it. When you're an analyst in an investment bank, there's salespeople, there's sales traders, and there's analysts. But even the analyst needs to do a sales pitch to, the fund managers and the PMs and everybody that makes the bank money. Because that's at least at that time, the way it worked is that you're working on a trading floor, and as an analyst, you write research, and you gotta comment on that and present it to fund managers and portfolio managers and whoever else is the client of the bank. And then the sales trader would pick up orders, and the trader would execute orders. And only then, when the client would give an order to buy or sell to the bank, that's where we would start making money. So there was a distinct sales requirement to that job. And I remember very well that we got courses, so all the salespeople and the analysts were from time to time giving, courses, sales trainings on how do you sell, how do you pitch your work to your counterparts, to your clients, to those professional PMs, because these guys are always busy. We're talking about PMs at Fidelity and Wellington and all the big fund managers who were bombarded by brokers. And I have absolutely zero clue what else was said in the course, but there is one thing that I remember very, very vividly, because the trainer was a Scot. He had a very Scottish accent, He was from Edinburgh, so that's how we spoke. And during that course, there was one sentence that stood out, and he said, "If you want to reach your client, you got to make the facts sizzle." And that to me was like, okay, you got to stand out, and you got to make the fact sizzle. Is all about what is your headline, what is your message. You got to, basically, the way I translate it is, you got to capture the interest of that guy, like in the first 5 seconds of whatever your pitch is. And that's obviously difficult, because everybody's looking at the same stocks, everybody's looking at the same markets, everybody read the same newspapers, everybody read the same headlines. And even if you're competing with fellow technicians, they're all looking at the same charts. So how do you stand out? How do you come up with something different? So that was one thing. very early in my career, I had already figured out that relative strength was the way to go when you're in the institutional space. Pretty much all of these guys and girls are in the relative strength game. If you're a professional PM, you're giving a mandate. Assume you're a US large cap fund manager. Your benchmark will very likely be the S&P 500. And your job is to beat the S&P 500. I was in Europe, still am. So here, the equivalent would be someone who is, let's say, a portfolio manager in European large cap stocks. So his benchmark would very likely be like the Stocks 50 or the Stock 600 or some whatever large cap stock market index. And they will have very, very limited room in their portfolio to go cash because they need to be fully invested. The decision to not invest in stocks is taken at a different level. It's much more at an asset allocation level. So by the time the money hits that large cap fund or the technology fund or the biotech fund or whatever fund it is, the decision to invest in that particular sector and that particular market has already been taken. So it's not the job of that fund manager to decide I'm going to go cash because I don't trust the markets. If the owner of the money didn't trust the markets, he would have pulled the money from the fund. So there you have the difficulty of a professional PM. Even if you know or expect or are very sure that the market will go down, you cannot go to 100% cash or not even 50% cash. Maybe the bandwidth that they have is like maybe 5% cash. So what they need is stocks or sectors in their universe that outperform the market. So when they go up, they need to be in stocks that go up faster than the market. When the market goes down, they need to be in stocks that go down less than the market. It's the game where the market loses 10%, your fund loses 5%, and you're a hero because you outperformed the market by 5%. You still lost 5% of your clients' money, but that doesn't matter. You outperformed the market by 5%. So basically, in the technical toolkit, relative strength, comparative relative strength, is really the only thing that helps you identify those trends. And as a side note, when I was working on the buy side with Robeco still, we had a bonus scheme that would pay out if we was the Dutch AEX index. And we already figured out that if we would keep all those 25 stocks on a buy recommendation, we would be the benchmark. So we would never get our bonuses. So figuring out that we needed relative strength to sort of distinguish which stocks we needed, and that all, came together when I started working with institutional clients. So I started using that, and then I found out that one of the most asked questions by those fund managers was, what are your best 5 stocks? What are your best 5 sectors? Where should I be investing? And that was the I could not always answer that question because imagine I was a technical analyst, so I was actually covering about 600 stocks in 18 sectors. So if I was preparing a pitch for an institutional manager, I would pick 1 or 2 sectors and a couple of stocks that I might discuss with him. My fundamental counterparts, the fundamental analysts, were they had it much easier, because if you're a biotech analyst, you got maybe 20 stocks. So when you talk to one of these fund managers, it's very easy. You know what it's going to talk about. So when I spoke with them, it was always something else. Julius, it's Technology Week. I'm going to speak with Goldman Sachs is coming here with a conference. Morgan Stanley is organizing a roadshow. What are your best 5 stocks in the technology sector? And I obviously hadn't prepared that. I was looking at chemicals or banks or whatever. So I needed something to answer that question, and it needed to be based on relative strength. So I was actually developing a tool, or I was looking for some way to rank a universe based on relative strength.
You said something which was a little bit of an aha moment. I hadn't thought of it in those terms, but the reason why sector relative strength works is because of mandates on the institutional side. To your point, they cannot raise cash beyond a certain level, so the best they can do is simply reallocate and effectively change the sector beta makeup.
Exactly. That's exactly what it is. Yeah, and you know all about that because you wrote a study about it. That's how we met. That's how I know you, actually.
Right, exactly right. Around utilities.
that utility stuff. Yeah,
Right, exactly.
that's totally up my alley, and I thought that was very interesting. So I started working on some way of ranking that relative strength, and that method sort of evolved into what is now known as the JDK-RS ratio, which is basically the horizontal scale on an RRG, which we get to a little bit later. I'll try to describe that. So I started using that in my work as a ranking mechanism, and started publishing that and wrote reports on that. And this was 2000s, 2000, 2001, 2000, basically during the dot-com bubble. And it was quite funny because, yeah, I thought it was like, all right, I got this. This is cool, and I can answer that question, and that's all fine. And then all of a sudden, in 2000 something, that these technology stocks, because there is a trend following element to that algorithm. So all these tech stocks were like on a buy recommendation in my work. They were on the top of the list, and then that whole sector started coming down, and all these stocks started coming down. But something that is way up there, it takes a little bit of time before it rolls over and starts to move down. So that I got an email from an Italian hedge fund investor saying, "Hey Julius, this time your system didn't work too well," and I just had like, yeah, he's right. There's an element of truth to that. So back to the drawing board. What can I do? And I thought, I need a sort of an early warning system. I need some sort of an indicator that kind of warns me when things are starting to deteriorate. And I started to play around with momentum and rate of change, because that's pretty much the only leading indicator in the tech toolkit. Because before something rolls over, the first thing that was happening is that momentum starts to flatten and roll over. So I started to play around with that. First of all, that RS ratio. The problem with comparative relative strength is that you can make that calculation very easily, but you can only use it on a single security. That the numerical value that you get when you do a raw relative strength comparison, you cannot compare it to something else. You need to look at the trend, and that's where the difficulties come in. And there is a lot of publications like Barron's and a lot of people, especially in the US, they do like 6-month relative strength, 12-month relative strength, basically anchoring that relative strength back a fixed period, and then see whether that stock or sector has done better or worse than the benchmark. But for me, that was way too late. I want to pick it up when that trend starts to change. Then you need to do some modifications to actually pick up these trends and make them comparable across a universe. Because remember, I still needed to answer the question of that fund manager: what is your best sector or what is your worst sector? And with that momentum play, with that rate of change stuff, the same problem arises. So I worked around that, figured that out, and then I had two values. I had the RS ratio and I had RS momentum. And at that time, I was basically publishing them in a table and as a graph, under like 2 lines under a graph. And literally at some, unforeseen moment, I was basically playing around with my Excel spreadsheet, trying to kind of beautify my presentation of my data. And I selected those 2 columns because I also did a selection and then ranked them based on the columns, and I wrote about it like these are the strongest and these are the strongest gainers based on momentum, and how you do a market comment or present it to specific users. And I had those 2 columns selected, and I was clicking through the various graphical formats that Excel gives you, and all of a sudden I hit a scatter plot. I was like, so it populated with dots, and I was like, oh, what's this? So I was looking at it, it's like, oh, this is interesting, but then you know that feeling when you look at the graph and you think it's interesting, but what exactly am I looking at? So that
It happens all the time in markets.
So I was like, all right, what is this? And I started to basically peel it off. Like, all right, what is this? What's on the horizontal scale? What's on the vertical scale? What do these dots mean? And so started working around it and saying, all right, this is cool. This is interesting. And started actually publishing it in my work in a very, very basic format. And then I thought, you know what? We're technicians. We want to see the history of something. So I started doing some visual basic coding, VBA coding in Excel, basically plotting a secondary group of sectors, like the previous value. So then I had for every sector, because I was looking at sectors at the start, for every sector I had 2 dots, like the actual, the current, and the previous observation. And then I figured out how I could shade the previous one. So the last one, the current one, was like a bright color, and then the previous one was like a dimmed shade color. So I could see where it was moving from, and I started to publish that in my PDF reports, which they were at the time. And you know Dave Keller, right? You know Dave.
I had him on a Twitter space,
Yeah.
a few months ago.
So David at that time was director of technical analysis at Fidelity, and he was one of my clients and a user of my research. And as an analyst, I was having my regular calls with David to just go over what we presented and what we thought, etc., etc. And in one of these calls, Dave tells me, he said, "You know what? That last page in your report, which was basically that might, well, call it an RRG now. It wasn't at the time, but that graph you plot there, I print that page and I stick it on the wall, and I keep a stack of those." I asked him, why would you do that? And he said, "You know what? So you guys, you've all been in high school. So when you have your notebook, and you remember when you draw that little man on the bottom, like a head and then a stick and then 2 feet and arms, and then on the next page you would draw the same man, but the arms would and the legs would move a little bit, and then when you go over all the pages, that man started to walk." That's what he did with that last page, and that's how he could see that the rotation is starting to take place. And for me, that was my kind of aha moment, like, oh, that's interesting. So I started to play around with that. And that actually revealed that rotational nature of markets. And for me at that time, it was like, hey, you know what? Everybody's always talking about sector rotation, but now you can see that it is actually a rotation. It's a clockwise rotation, and it goes around the benchmark. And that was the moment I was like, right, this is very cool. Now we've got something. And then I started to VBA code a little bit more, make those tails a little bit longer, and actually make them animated them so they could actually be played around over time. And that's how that whole graphical format started into life. And at that time, it was just for me and for the clients of the bank, and it was my spreadsheet, and I still have it somewhere. If I would give it to you, you would not be able to understand it. It's one of those spreadsheets with thousands of lines and a lot of VBA code, and only the person who wrote that code and who owns the spreadsheet knows what to do. It's like, oh, if you change cell C3, then on that tab B55 will change, that kind of stuff. And then I was invited by Bloomberg every now and then to do a presentation for their clients. And that happened again somewhere in 2005, I think. And I remember well was a presentation in Zurich. And I thought, you know what, I'm going to show this visualization, this graph. I'm going to put it on the screen and just talk to it about people. And that was received very well, and the Bloomberg AppSpec who was there said, "Hey, this is interesting. You need to show this to our head of graphics in New York." And I said, "Yeah, that's very interesting, but I'm not going to fly to New York just to show one guy I don't know a graph of which I don't know what the result will be. So we'll see how that works." And then, a couple of months later, I got a call from Guido, who was the AppSpec, say, "Hey, that head of graphics, which is Eugene Sorensen, or he now left Bloomberg, but at the time Eugene was the head of graphics in New York. He was in the Frankfurt office of Bloomberg. So I drove to Frankfurt from Amsterdam to Frankfurt. That's about a 5-6 hour drive for that single meeting, and it was I call it a very American meeting. The entire meeting lasted 20 minutes, and after 10 minutes, Eugene said, "I want it on the system." And that was it. The decision was taken. It would get on the system, but it took until 2011 before it actually got there. And there was a whole heap of problems why that was happening, primarily technology, because the Bloomberg terminal at that time could only handle price time graphs. So on the horizontal scale, time, and on the vertical scale, price. Nothing else was possible. So the entire infrastructure of the graphical interface of Bloomberg needed to change, which was Eugene's job anyway to do that. And that took until 2010, and then in October 2010 they were ready, and I got a call like we're ready to program it. And from that point onwards, it went very, very fast. And then in January 2011, RRG Go was launched on the Bloomberg terminal, and that's when things really started to get traction, because that's when more eyeballs actually were received. So very rapidly after that, Thomson Reuters called me and they asked me if they could have it. And after that, the platforms where it now is. So that's Optima, that's StockCharts.com. It's in Hong Kong. The Hong Kong Economic Journal has a version. Last year we launched a version of RRG on the EMEA website of State Street for their sector spiders, and we're talking to a bunch of companies to embed it on their platform. So that's the yeast of how relative rotation graphs actually came to life, from being a way for me to put myself apart from the herd, so to say, in research, in technical research, to give something to professional fund managers that would stand out and would give them in one shot, in one graph, basically everything they needed to know from a high level perspective, to how Bloomberg picked it up, and then all the others followed with their technology.
Just to reset the room for the remaining roughly 15 minutes or so, everybody please make sure you follow Julius here on Twitter, because if you've seen these graphs and you want to go directly to the source, I'm sure he would love to be bothered by you.
Absolutely.
On Twitter.
Absolutely.
And again, if you want to come up and ask questions, feel free to click on that bottom left mic request button. I want to get into the current rotation dynamics you're seeing for the audience. If you're there, go ahead.
Well, obviously, when it comes to relative strength and RRG, those are the what I call the RRG lines. So that's the JDK RS ratio and RS momentum. Those are the building blocks for an RRG. And when it comes to other technical indicators, I really don't use that much. I'm very much a trend analyst, so I look for trends. I use the occasional moving average, but that's really just to get a handle on, like, sort of smooth out a trend. And if I look at a single chart and I need to make up my mind on a single, I'm a very basic RSI MACD type guy. I don't use much other stuff. I look at the charts and those tell me the story. I try to figure that out with very, very basic inputs. So the price is way more important than everything else, which is only a derivative of price. So I'd like to keep it very, very simple. And if it goes in, because your question was on the time frames, obviously that depends very much on the investment horizon of either yourself or the client that you're talking to. For me personally, most of my stuff is done on weekly charts. I like to look at a little bit longer term trends. I'm certainly not a day trader. I try to play sometimes on swing trades that take from a couple of days to a couple of weeks, but the time frame that I do my research on and do my work on is usually a little bit longer term. And that all has to do with the background with these professional fund managers, because when you're providing technical research to a professional fund manager, you really can't get away with writing a note this day that you need to buy the utility sector, and then 2 days later you need to get out of the utility sector. That's just not going to work. It's not going to cut it, because when these guys start buying, maybe they need 3 weeks to get to the position that they really need. So when you switch within a couple of days, that's just not going to be very helpful for them. So that's primarily my reason to work with a little bit longer term timeframes. And what I've learned, what I tell people when they work with RRG and relative strength trends, because that's what you're looking actually at, trends and relative strength. RRG is just a visualization of that to bring it all together. I always keep as a rule of thumb that when I change a recommendation, or if you want to call it a signal, also fine, that should last roughly or a minimum of 3 months. But very often these trends take much, much longer. So I also, as an analyst, I always told these people, when I write a note and you read it 2 days after it was written, it shouldn't be a problem. The content should still be valid and still be okay, because we're looking at a little bit longer term trends. And I was also of the opinion that as a research analyst, The PMs are bombarded with mails every day. Their inboxes are like the Reuters headlines. They're scrolling by. It's crazy. So you want to be in one of the mails that when they see it, they really want to read it. And if you write a daily note, then the odds that that note gets lost are increasingly high. So I'd rather write a few notes that they really pick up and act on than an everyday note that only 1% of your audience reads every now and then. So from a time frame perspective, using the weekly time frame, my rule of thumb is that you get trends that last at least 3 months, very often much longer. There will be the odd exception where it doesn't work out, but that's really the exception that confirms the rule. If you want to translate that to a daily time frame, you're talking about 3 weeks. That's about the same kind of order of magnitude that you can look at, and you can translate that all the way back down to if people use RRGs on hourly or half-hour charts or whatever they want. But that's a bit of the time frame.
Let's talk about where we are currently. Any sort of interesting rotations that are happening? I mean, I'm a bit surprised it hasn't really kicked off in a big way, but utilities I keep myself looking for as a sort of major potential, not just warning sign of a correction, but just as a allocation play for those that want to be long only. And you and I both know utilities are unique in that it tends to be the lowest weighted sector for most of the money managers that are benchmarked against the S&P. What are you observing as far as relative strength? It's more than just regional banks as the point of weakness.
Yeah, the interesting thing is that I've started probably already a couple of years ago. I started to distinguish or separate the sectors. If we stick with the 11 S&P sectors, probably easiest for the conversation right now. We started to separate them into offensive, defensive, and sensitive groups. And I try to keep an eye on how the rotation of these groups are playing out. And it was interesting that at the end of 2021, what you saw is that there was a very strong rotation to defensive sectors, and the market wasn't going to come down. And you rightfully what you just said, these defensive sectors. So that's utilities, staples, and healthcare. Healthcare is quite a big sector, but utilities and staples are really small sectors. And they started to really improve on the RRG. And I was surprised because usually those sectors do well when the market is in a downtrend or is rolling over or in a weak overall market. But that wasn't happening. And a little bit later, you saw that money was starting to flow out of the offensive or the cyclical sectors. And the cyclical sectors, that's discretionary, that's financials, that's real estate, and that's materials. And then the split started to become more and more visible. And what was surprising is that there was so much money flowing into those defensive sectors that amount of money was enough, at least for the last part of that bull market, to push the market higher, which was quite surprisingly because 3 sectors, and then the sensitive sectors, that is communication services, technology, industrials, and energy. And at that stage, it was also energy that was helping. So you had a small group of sectors, most of them not very heavyweights, that were attracting so much money that they could keep the S&P from falling. And that was, for me, that was sort of an under the hood warning signal because those sectors were safe havens. And then when at the start of 2022, when money really started to move out of that offensive group of sectors, things really started to roll over. And you saw the opposite moving at the start of this year when you saw money moving out of defense and into offense and started that move higher. And if we go to the current day, then you see an interesting situation because utility, staples, and healthcare are now in the improving quadrant. So they're starting to make their way back to leading. And you see that discretionary, so the offensive group, are basically all now in the lagging quadrant, except for discretionary. That's inside improving, but it's heading back down to lagging. And the two strongest sectors at the moment are communication services and technology. They're way up in the leading quadrant. They're the sensitive sectors, economically sensitive sectors. And obviously, technology is the heavyweight. Communication services is around 8%, so that's also pretty strong. So right now, the market is being held up by defense and two of the economical sensitive sectors, of which technology is the most important one. And I think that is the reason why there is not enough push for the S&P 500 to overcome that overhead resistance barrier that is now getting stronger and stronger around, what is it, for I don't even know on top of my head. So yeah, so that's how I read 4200, 4175. Yeah, that's how I use the sector rotation to get a grip on the bigger picture for the market as a whole.
Yeah, and that dynamic is, I'm glad you said improving on utilities, staples, and healthcare. I mean,
yes,
these areas tend to lead. So it really is amazing the bifurcation that's happening in the market, in the sense that, to your point, the headline averages are being held up by tech largely. So it looks like we're still in bull mode. You look at small caps, not so much. Look at discretionary stocks, not so much. Defensives showing improvement as tech is still leading is curious, right? Would maybe suggest that there's a anticipation of volatility to come in the short term. What, from your studies, Julius, are there? Yeah, I've talked about utilities before, but are there other sectors or industries that, when they start to improve, tell you something about the likely direction of stocks? In other words, they have a leading aspect to their relative strength.
Well, I mean, I guess what I just explained, I'd like to break it down into those three groups, and that has helped me very well. Another breakdown that I very often use is growth and value. So I break the market down in growth and value. You can do that very well on an RRG. You can plot the growth and value indexes, and I have one RRG which also breaks down the growth and value indexes into mid, large, and small. And that's an interesting graph because it shows you where the strength is picking up and where the weakness is coming in. And it's actually so funny that we do this talk, and I've done a podcast and we talk about something that is so visual as RRG, and we do it all without a graphical image in front of us. That's kind of counterintuitive, but still we try. So when you bring up that RRG that breaks down growth and value into mid, small, and large, then what I see right here now is that growth in general, growth large, and small large are all inside the leading quadrant and moving to the right. So that means that they're picking up relative strength versus I compare that to the Dow Jones US index. So that's the entire US market. Everything else is inside the lagging quadrant. Also, and that's interesting, mid cap growth stocks. So large cap and small cap growth are leading, and mid cap growth is actually moving quite rapidly into the lagging quadrant. And the value stuff is pretty much all on a negative trajectory. So I think the conclusion that we need to draw here is that the market is still growth orientated, especially the large cap, because the growth large cap is the strongest group at the moment. And that's, to me, very often you see that when large cap stocks are sort of a safe haven already. I mean, we've got the defensive stocks, utility, staples, healthcare, but large cap, as very often, small caps do very well in bull markets. And large caps are sort of, everybody seeks a safe haven. And with technology as the biggest sector being very strong right now, there's obviously a lot of large cap stocks in there. I think that people are also starting to see or starting to use technology as some sort of a safe haven play next to the traditionally defensive sectors, if that makes sense.
Which is kind of crazy. I mean, a lot of people have made that point, including myself. I mean, I think a large part of that is driven by still ongoing skepticism around bonds, which would typically be the beneficiary of a period of heightened volatility. If people are still nervous about bonds and they don't want to be in cash, what do? They just rotate into the Apples of the world, the Microsofts of the world.
Yeah.
Right, but that only can last for so long, arguably.
Yeah, and it's quite interesting that you mentioned volatility, because volatility hasn't really taken off to the upside, has it? I mean, we're still in the 20, so it's not that volatility all of a sudden jumped. Even with the rotation that's currently going on, volatility is still quite low. I'd like to argue. If you really want to get volatility back up, what is it, 25, 30, etc., then things start, maybe, shit starts hitting the fan. But that's not happening yet. And I write a blog on stockcharts.com, and one of my recent articles had some sort of a headline saying, when a market is not marked down on bad news. That's there have been so many possible excuses for the market to go down. Bad news, rate hikes, rotation to defensive, and still it's holding up. I mean, it's not going up, but it's also not going down. And I am trying to figure out what that means. Is that do we need to see that as a sign of strength? Is everybody still pouring more money into the market so that it doesn't come down, or is this the last straw that we're holding, and are we looking, to roll over when people eventually start selling big tech, and that growth play is over, and technology moves out of leading, and it'll all go to defense, and we will see a bigger decline in the S&P 500. At the moment, I'm sort of in limbo. I think it can go either way, but we will get a quite bigger move sooner or later, which is more pronounced. That's for sure.
For those in the audience, Julius, that want to look into RRG and the kind of work that you've done, what are some places they can turn to?
Probably the best way, there's the relativerotationgraphs.com website. That's quite old. We're working on a new one. But the best place probably to go is stockcharts.com. I write a blog there. It's the RRG charts blog, and I do a weekly show every Tuesday called Sector Spotlight, where I discuss market conditions, and I've got a few segments. I look at a sector rotation model. I look at a combined seasonality with sector rotation to sort of get a forward-looking way of current. I try to align theoreticals from the seasonality, or the expected seasonality, with what I see in the current rotations. And then there's the blog that I write pretty much one article every week going into current market situations, or whatever people ask me. I'm pretty open to, my email is all over the place. I'm pretty happy to take questions and try to answer some of the questions in my show live as well. So yeah, that's probably the best way to reach me, or to follow what I do.
Everybody, please make sure you follow Julius de Kempenaer here on Twitter. See, I said it correctly that time, I think.
At RRG Research.
At RRG Research.
That's the handle.
And appreciate those that keep joining these conversations. And Julius, really appreciate your knowledge here.